Well, today's a great day at the Cavalieri Group, and today I have Mr. Matt Bell, a CPA from the firm of Harding Bell International. It's a big firm. They do a lot of international and also, of course, domestic. What makes them very interesting is not only they're the typical CPAs, they not only do the numbers, they also can guide you, especially if you have specific circumstances, in your business or the way that you manage your transactions. So, Matt, welcome to this interview. And could you tell us briefly a little bit about you?
Yeah, I sure can. Well, I appreciate you inviting me on today. So my name's Matt Bell. I'm a certified public accountant. Myself and my brother Steve Bell have a firm called Harding Bell International. We have about 35 total staff in 3 different offices, and we deal with your typical domestic type tax returns and tax advice and tax planning, but also a lot of international. As we were talking about earlier, we have clients from, I believe, 115 different countries that actually come and invest in the United States. So we help them structure their deals to make sure that it's the most tax efficient that it can be here in the United States as well as in their home country.
Yeah. Okay. Excellent, Matt. Thank you very much for your time. I know you're a very busy gentleman. I think we're approaching those important dates for tax filing and some
We're
deadlines
getting
coming
there.
up. We're going to get into politics in part of the conversation to the middle of the conversation, so people stay tuned. So we're going to go to that pretty soon. Okay, so we're going to see what do you see in regards to the Biden administration and what they're going to do. All right,
Yeah.
so let's start with the basic question. Most people ask me, Salvatore, I want to invest for the first time. Do I do it under my name or do I do an LLC, which you can form also entities as far as I remember, correct?
Yeah, that's right. So our firm, we do a lot of advising on entity formation. We work with some attorneys to get the paperwork drawn up properly for that. But as far as first-time investors, really having an entity like an LLC, for instance, a limited liability company, can provide some tax benefits depending on what country they're from. So, for instance, if someone was from Canada, I probably would not put them in an LLC because Revenue Canada doesn't like LLCs from a taxation point of view, and they tax them different than they do here in the U.S.
Okay.
So entity structures can be good, LLCs and corporations for investing. A lot of times we have clients from other countries who are wanting to bring profits from their foreign companies into the United States. And so how they do that without getting taxed in their home country is they'll set a subsidiary up in Florida or whatever state they're investing in, and then bring that money over, put it into the subsidiary, usually a corporation, and then that keeps them from paying dividends tax in their home country. So, that's one way that setting up an entity can help with taxation. But one of the big benefits is really legal liability protection. So if we have clients who, may be high net worth individuals, possibly individuals who are famous. In other words, if you knew their name, saw that on a property tax record, you know who they are.
Yeah.
They're concerned about remaining anonymous on owning properties, or also someone who has a lot of assets, maybe not a lot of income, but they've built up a lot of assets over the years, and they're concerned about having a rental property and someone getting hurt in it and possibly filing a lawsuit.
Yeah.
An entity, depending on how it's structured, sometimes using trusts can actually fix all those things and make them anonymous so no one can tell who owns the property.
Okay.
They can provide legal liability protection and for their income and for their assets.
Yeah, in this anonymity can be done for domestic and also for international clients, I would assume.
That's correct.
And
Yeah.
and you can help in this solution, provide a solution for this.
Yes, we can.
Excellent. I have another question. We have some high earners, and they have bought property, kind of one here, one there. They didn't have a set plan,
Right.
and the comment that they're receiving from, their CPA, and I don't know the details, it is that they're maxed out in whatever deductions they can, and buying real estate really wouldn't help them.
Right.
If this possible first, and then how can the person, be able to save the most in taxes?
Yeah, so probably what they're talking about is what we call passive activity losses. So once you get to a certain income level, your losses, if you're generating them from rental properties, can't be used to offset your ordinary income. So if you're a doctor, you're an attorney who's earning a lot of money, and you have passive investments, if those investments are throwing off losses, there's some limitations on using those losses to offset your current income.
Okay.
A couple of things here. So I wouldn't say that owning a rental property isn't an advantage for those people, because one of the things is with depreciation on the property, let's say you buy a property and your depreciation is 10,000 a year. I'm just going to throw out a number.
Yeah. Okay.
If you buy a short-term rental property, the furniture can be written off all in 1 year,
Okay.
which creates a loss, a tax loss. The property itself, if it's residential, can be written off over 27 and a half years. So when you add that depreciation in, let's say it's $10,000 of depreciation. That depreciation expense is not a it's not a cash expense you're paying out. It's essentially a tax transaction that can be used to offset the income that's being generated on the rental property. So in effect, you're getting $10,000 in that example of tax-free income,
Yeah.
cash flow that you're not paying any income tax on. The second thing is, one thing that we've done for a lot of our clients is to make what we call the real estate professional election. So
Okay.
I'll give you an example for me. So I'm a CPA. Um, the income level that I make, some of these deductions wouldn't be real good for me. But my wife is a homemaker. So, she takes care of me, takes care of the house, takes care of our kids.
Yeah.
And she doesn't have an outside job where she's earning income. But a possibility would be to have her as the owner and manager of our real estate properties. Allow her to make what we call the real estate professional election. And what
Okay.
that does, that turns that passive loss into an active loss that can be used to offset any type of income. So, in that example, that would work with an attorney or a doctor or anyone that was earning a pretty high income level in their business, but they have a spouse that isn't out there earning, and that's pretty typical. We have
Very
quite a
difficult.
few friends that are they're physicians. The husband or the wife is the physician. They are the main income generator, and the spouse is taking care of the home and doing other things. The spouse can be the real estate investor and can take some of those losses and offset the active income. So that's a really good possibility that I think a lot of CPAs miss.
Yes. Okay, excellent. So right there, you just mentioned two big ones: depreciation, residential, 27.5 years, commercial will be 39, right? And then we have also that a spouse could also be working at the real estate side of the business. And how many hours will be required? A minimum number of hours of work, or?
Yeah, so it's 750 hours a year that has to be done in that real estate profession to be able to make that election. And you don't have to be a licensed realtor for this. So
Okay.
you can be just a
Okay.
rental property owner. If that's your primary business and you're spending at least 750 hours a year on that particular job, then you can be classed as a real estate professional.
Yeah, this is actually 750 is pretty doable, because
Yeah.
some of the clients we have multiple properties, and they are constantly solving and managing and doing different things. Excellent. Besides the spouse, children could also be part of the deductions if they perform work.
They could. So if you have kids, minor children that are under a certain age, it's a possibility to pay them some salary. if they're going
Okay.
to be taking care of that. And that's a way to shift some income, possibly to lower tax brackets. A lot of people have kids who are, that they're going to school, they're not really earning any income.
Right.
The ability to pay them some type of salary
Yeah.
is a possibility, and there's some record keeping requirements there to be able to do that probably we don't need to get into today, but that is definitely a possibility to pay children, shift some of that income from maybe a 37% tax bracket down to 10% tax bracket or lower.
Wow. Everything helps. No, right now you just provided a wealth of information, depreciation right there. Then we have the spouse, wife, or maybe the husband, and then we have the children as well. Everybody chipping in to grow this business. All of that could be deducted for high earners. So this is amazing information. Thank you, Matt. So let's switch quickly. What are the five top expenses that can be deducted when you do real estate?
Yeah, so I'd say the thing that we see the most of, number one, probably is going to be depreciation,
Mhm.
especially if there are furniture and appliances in the property. So we have a lot of clients that have short-term rentals, and of course, all of those are going to have furniture packages in them. Right now, under the current tax law, furniture packages can be written off pretty much 100% in the first year. So if you go and buy a short-term rental property, put $50,000 of furniture in it, you basically have a $50,000 deduction right off the bat. So that's number one. The second thing would be auto and travel. So
Mm,
for people that live out of state, whether they fly down to Florida or they drive, there's mileage deductions that can be taken for driving, the travel expenses for flying, for rental car, or if they rent a hotel instead of staying in the property. All those things can be taken, including there are some meal deductions that can be taken. So there's a standard rate that can be taken each day for meals and incidentals. It's called a per diem rate if they're out traveling into
okay.
Florida. So that's something that we can take as well. I would say probably the third thing would be making sure that everything that they're buying for the property they're accounting for. So a lot of times people will go out, they'll hire a property management company to do a lot of the daily cleaning and things like that. But every time they're down in Florida, they're going to either Walmart or Sam's Club, one of those places, buying a lot of supplies, put into the properties, really just keeping an Excel spreadsheet to give to their accountants is going to be a big part of that. I think the other things are pretty typical, really just the normal operating expenses of the rental properties and the way the IRS really classifies what can be deducted. They say that any ordinary and necessary business expenses can be deducted. So if it's ordinary in the course of maintaining a rental property and it's necessary to do that, then you can take a deduction for it. So, that could even be possibly some home office expense in their home that they live in.
Yeah.
We can take a deduction for that if that's being used exclusively for the rental property.
Yeah. Any specific deduction that you see most people forgetting that they just don't do?
I think the travel is a big part of it.
Travel. Wow,
Yeah,
interesting. The travel.
yeah.
We are in 2021, okay? For 2020, I'm not sure, but is our meals 100% deductible? Typically, we're at 50%. If I remember well,
Yeah.
is it now 100%?
It is if it's being used to take out and entertain clients. So that's kind of the criteria there. You've got to be a little careful of is that it needs to be, taking out a tenant or discussing that particular business. So it is 100% deductible right now. The main thing to remember is to keep receipts from the
Yeah,
restaurant and put on that receipt who you met with and what was discussed. So
yeah.
that's the criteria that needs to be met for that.
Okay, so receipts, paper, electronic, some kind of receipt has to be there,
That's
and
right.
document probably the conversation that went on. I went out with tenant Mary, and we discussed X, Y, and Z. Okay,
Exactly.
excellent. Now let's talk about politics, which is a kind of a interesting conversation. Biden, new president. Uh, what have you heard? Do you think there is something that's going to change radically? And how can investors listening will be able to hold the tide?
Yeah, so it's a little hard to know exactly what he's going to be able to pass. I know in hearing some of the promises of what he wanted to change, you know, there was talk about higher tax rates. So there was a discussion about capital gains tax rates possibly getting raised to 28%.
Mhm.
Currently, they're either 0, 15%, or 20%, depending on exactly how much money you're making in capital gains each year. So talk of raising that. There's a discussion about raising or sorry, lowering the estate tax exemption. Currently, it's I don't know the exact number, but it's about $11.6 million that you could have in your estate to not have to pay tax if you passed away. There's
Okay.
talk about lowering that. So
Okay.
people that have a lot of assets, that could be an issue. I think the final thing that I had heard a little bit about was discussion of changing who is eligible for 1031 exchanges
Mm.
and whether they were going to be completely eliminated. So I haven't heard anything being talked about since he's been elected. I think probably, I doubt this year we're going to see a whole lot. I think maybe in the second or third year of his presidency, there could be a push to change some of those rates. But
Mm.
there's going to have to be enough Democrats to vote for those changes. The Republicans are pretty much going to be completely against it, I can guarantee you. So, it's going to have to be reasonable changes for them to get passed because there's a really thin majority of Democratic control in Congress. And, a lot of those folks that are in Congress make a lot of money and they have a lot of investments where they are getting capital gains themselves. So there's a pretty good incentive to push back a little bit if things try to get floated across that are going to increase their taxes significantly. But I would say what can be done right now to try to mitigate that. I honestly wouldn't do a whole lot. I would wait and see kind of how things flesh out. And if we see things getting shifted toward a higher capital gains tax rate, there's a possibility of maybe creating what we call a C corporation to actually own properties. If the capital gains tax rates go up to 28%, C corporations right now are taxed at 21%. So there's some advantage there, assuming the corporate rates don't go up. Some
Mm.
possibilities. Hopefully the 1031 exchange side of things will not get eliminated. I think that's going to be a tough one for them to get through personally. I don't see that going away anytime soon.
It's a very good point. Actually, a very interesting point that you made is a lot of those senators, they have a lot of wealth accumulated through businesses or real estate themselves. Some of them have multiple homes, and
Yeah.
for sure they will be watching their own egg nest, for what they do on that. So excellent. Now, so we live in the lovely state of Florida, very sunny. People move here. A lot of people moving from other states. One question I always get asked, let's say someone is from New York,
Mhm.
lives in New York, has a rental property in Florida, and would the property in Florida, through depreciation and other expenses, would help them lower their taxes in New York, or they're not related?
Well, if there's depreciation in Florida, that definitely could help them lower their taxes. If the depreciation is, for instance, on a short-term rental, if that's generating a loss, if we wrote the furniture off all in 1 year, that could definitely be used to offset New York or New Jersey taxes.
Yeah.
Something we have to look at on a case-by-case basis. In general, those people living in their home state are going to be taxed on their income no matter where it's being derived.
Yeah.
So if they generate income in Florida, they're still going to pay tax in their home state on that income. But if they have a loss in Florida because of depreciation, not because of normal operating expenses, but because of this tax write-off, then
Yeah.
that can be used generally to offset their taxes in their home state.
Oh, excellent. More than one will be very happy today to hear that. Now, Matt, uh, probably you have seen in social media there are experts in the field of real estate, and they're selling courses and they're selling how to do this and how to do that. Be independent, make your own money with real estate, quit your job soon, etc., etc. And some of them claim that taxes can be taken to zero legally,
Yeah.
0%. Is this a myth, or there's a way that it can actually be done?
Well, they can be brought to zero if you're investing in things, for instance, such as passive investments like real estate. So if you have enough properties where you have a depreciation deduction that you're taking every year, I mean, you can get cash flow out of those individual properties
Hmm?
without paying tax on it. Now, at some point down the road, that has to be recaptured. But what I would say about a lot of these online courses, these guys that tend to claim to make their money on their own advice are really just making money on the fees they're charging. And we've had a few clients that have gone to those courses, and to be honest with you, we've had some of them pay $100,000 in fees for courses. And I would say that 95% of what they've learned in these courses, we could have given them for a lot less money. I mean, those are things that we give advice in the course of doing business with them. So I would caution people listening too much to gurus. A lot of these courses that you see are, come to my course, it's $500, but there's always an upsell every single time.
Yeah.
So
Yeah.
just be careful about that. But it is possible to pay zero tax depending on what type of investments you're in. We have clients that don't pay any income tax every year because in fact, I have family members that don't pay any income tax because all of their income is generated off of rental properties that
Okay.
have depreciation deductions that they're taking every year.
Yeah.
So
I guess buyer be aware, and there is a possibility, and that's the reason we're having this conversation, because you are the gentleman. Your firm can, from the get-go, start drafting the plan for this family that maybe they're here right now and they want to grow to up here in terms of assets and being able to have passive income and being able to write off as much as possible legally. So clearly you are and your firm is the solution for that. Now, interesting. I have some people have asked me, okay, what do I do first? Do I pay off my house, no mortgage, and start investing, or can I do both at the same time? So that was a question that I get often.
yeah, so I think right now, for me personally, with the interest rates as low as they are,
Mm-hmm.
if you are able to not just pay off your own mortgage and use some of that money to invest in properties, anytime you can leverage your investments, you have the potential to make more money. So it's just like if you have a stock or bond account and you use margin to buy your investments,
Mm-hmm.
you have a lot more buying power to do that. Same thing with having a mortgage on your house. I mean, most people, I would say, have a mortgage on their primary residences because of the fact that not all of us have $500,000 cash laying around or whatever the amount is to just
Yeah.
go buy a house. So taking that money that you might use to pay off your own primary residence and invest it in something, I think right now, maybe not for every person. Some people are very, very conservative.
Mm-hmm.
For me,
Mm-hmm.
I'm the kind of guy that is a little more of a risk taker. So, when I play Monopoly, I put all my money on Park Place and Boardwalk.
Look behind me. I have Monopoly.
Yeah, I have to reel that back in a little bit sometimes because I get a little too aggressive. But I think that if you think about it, if your mortgage rate, your interest rate on your home mortgage is, let's just say 3% right now, And instead of paying that off, you can go buy an investment property where you make 10% a year. It makes sense to not pay off your mortgage. As the interest rates stay low, you paying off your mortgage early has less and less of a benefit. So, I think now is the time to do that if you're going to buy, for sure.
That's a great comment. So in my mind is the following. This is how I think, and tell me if my train of thought is correct. So I'm paying 3% interest, which is deductible from taxes. Why am I going to pay off the debt if the interest portion of it is being written off? There is no rush. Is that correct?
Well, yeah, I mean, so here's another possible advantage of getting a mortgage on a rental property as opposed to getting a mortgage on your personal residence. So, personal residences right now, since they've raised the standard deduction, if you have a married couple, you get $24,000 of what we call standard deduction. If you don't have at least $24,000 of mortgage interest, real estate taxes, and charitable contributions, those are kind of the big three, then the interest isn't doing you a whole lot of good on your primary residence. But taking out a mortgage on an investment property is able to be written off 100%. So there's no threshold. So, something to think about. I don't see a huge advantage to paying off, a residential mortgage right now. If you're wanting to use that money to go buy investment properties, use that cash to do that, and then even possibly take a mortgage out on investment properties. It gives you a little bit more buying power.
Okay, that's an excellent advice. Of course, you get a higher return doing that. All right. Now,
Right.
talking about another important topic. Let's say you buy residential investment property, residential, and I'm gonna house, townhouse, an apartment, a duplex below 4 units,
Right.
and versus a commercial property. And let's put them both in the same price range: $500,000 commercial property, $500,000 residential. When you put them both side to side in terms of dollar to purchase the item, which one of the two do you think in this scenario will give you the most deductions in your taxes?
Well, I mean, the biggest difference probably between commercial and residential are just the depreciation rates. So, looking at commercial, I think we talked about 39 years is what we're looking at. That's a lower amount of depreciation every year on commercial versus 27 and a half on residential, plus being able to deduct appliances and furniture at a quicker rate residential. So, just on the face of it, I would say residential is going to probably give you more bang for your buck. There are some opportunities in commercial to try to lower that depreciation life by doing a cost segregation study, but you have to have really big pieces of commercial property to make it worthwhile. There's a pretty big cost to get that done as well.
Correct. A cost segregation will be something like a building, and you cost segregate the elevator versus the sprinkler systems of the alarm. Okay, got it. That's for bigger properties. Okay, excellent. In which you do too. So that would be excellent. All right. So we're almost approaching the end of the interview, and I have one more question. Is in regards, I have also high earners. Most of them are doctors or attorneys. They have maxed out on their 401ks, and they have an extra cash laying around. So what do? They buy stocks, do you think so? Put it in the real estate? Which ones do you think is the one that gives them the best benefit in terms of tax reduction with that extra cash laying around now?
Yeah, well, I think as far as tax reduction, real estate is going to be probably the one to go for. Just with having this possibility of converting the passive losses, using the spouse to do that through the real estate professional election, that's a good possibility. Investing in the stock market, I mean, I don't really want to get into which is going to make you more money. I think it just depends on probably how good of an investor you are. And that's the same with real estate or stocks. But if you're looking at tax deductions,
You're right.
buying a share of stock in a company there's nothing you can do to offset that. There's no direct write-offs. In other words, if I buy, 100 shares of IBM stock, I can't write off generally any of my meals, my travel. There's nothing to really offset that against.
Okay.
Real estate, there are the opportunities to do that. So we can be a little more flexible on what deductions we can take. There's some more opportunities to offset that income that's coming out of the real estate. So I think from a tax saving standpoint, real estate would definitely be the way to go.
Okay, excellent. That clarified that very well. I was very careful when I said, in terms of taxes, because everybody risks taking. It varies. Some people like stocks. Okay, fine, and others prefer real estate. But in terms of benefits for taxes, clearly real estate has a long way ahead versus the stocks. Okay, excellent. That's very, very, very clear. Well, Matt, so how can we get in contact with you? How can we call you or email you so everybody listening will be able to contact you and start a great business relationship with your team? So how can we get in contact with you?
Sure. So you can check out our website. That's hbitax.com.
Mhm.
You can send an email to info@hbitax.com or call us, and our phone number is 863-968-1010. Either of those ways, myself or my brother Steve are happy to help and kind of get you started and answer questions that you may have.
Excellent. We're going to put it, when we finish the video, we're going to put all your information on the bottom so people will be able to capture that because it's extremely important. I cannot thank you enough for your time, busy time during the year. So this is Matthew Bell from Harding and Bell International, amazing CPAs. And thank you very much. And we're signing off right now. Bye-bye.
Bye-bye.